All right. Hey, happy Thursday, everybody. It's Jeremiah Taylor here at Ojo Labs. I see people are already coming in. As you join us this morning, welcome, welcome, welcome. Open up that chat bar, go in the chat bar, and tell us where in the world are you joining from today? I'll go first. By the way, it's Jeremiah Taylor. Hey, welcome to what is really kind of the second or maybe third iteration of this quarterly series on market updates that we're doing. We have an amazing speaker today for you. For those of you that just joined, jump in the chat. Tell us where you're joining us from today. Welcome, welcome. All right, let's see what we got. We got San Francisco, Kansas City. I got Austin, Georgia. I got another Austin, San Diego. Is it lunchtime in San Diego yet? Yeah, it's like 11 a.m. Y'all are awake. You just finished surfing, had a great breakfast burrito, ready for some housing stats. It's going to be a good day. San Luis Obispo, New York, Portland. I love it. All right. As everybody keeps coming in, I'm going to get us going because we have some amazing content for you today. As a reminder, this will be recorded. So many of you have joined us for our master classes in the past. This is today a bonus session. We heard when we had Dr. Lawrence Yoon on last year that this market insights and market information about what's happening in the crazy housing market we're in was mega valuable. So what we've done is we've gone out and we've partnered with one of the leading minds in this space to have him here today, and I'll introduce him momentarily, to give you more insights into how to navigate this market, what's happening in this market, how to understand it, and most importantly, how to explain it. So again, for those of you that just joined, my name is Jeremiah Taylor. I'm part of the Ojo Labs team. Welcome to today's market update. We're going to get rolling. We'll email this out. The format for today is we're going for an hour. We'll be going to the top of the hour. For the next 40-ish minutes, Logan is going to be talking about the market. I'll probably throw some questions in. But as you join, go ahead, drop in the chat where you're from, and then open up that Q&A box, because as Logan starts just dropping economic fire on you, we want you to give us questions back, because we're going to do some Q&A at the end. We want to make sure that you all really have a way to synthesize and explain this data for your clients. So here we go. Now, if you don't know and you don't already follow Logan Mohtashami, you will, and you will after today. We will share out all of his social links so that you can follow him. But Logan Mohtashami is a housing data analyst, financial writer, and blogger covering the U.S. economy, specializing in the housing market. Mohtashami is also a lead analyst for Housing Wire. Now retired from the mortgage industry, Logan has been called a social media star by the National Mortgage News and the Chart Guy. Mohtashami's astute analysis of economic data and years of direct lending experience allow him to present a unique, informed, and unbiased perspective on the financial markets. He's been an invited speaker to many conferences and is a frequent guest on CNBC and other news networks. Mohtashami is perhaps best known for his highly prescient yearly prediction articles and his predictions of the state of the housing market and mortgage rate trends published weekly on bankrate.com. He's been an invited speaker to AmeriCatalyst, California Association of Realtors, and several other economic conferences. And today it is my distinct pleasure to welcome Logan to the Ojo stage. So welcome, Logan. Thank you for joining us.
It is wonderful to be here, and we are going to so nerd out over the next hour. And as always, ask questions. No questions asked is always the bad question. There's a lot of data that's going to be presented, and it needs to be explained in a fashion that's easy for you to understand and also easy for your clients to understand what's going on in the state of the housing market.
Yeah, that's amazing. So you sent over some slides. I think we dive right in. Let's chart it up. I'm going to share my screen. Give me a thumbs up if you can see that. Okay, great. So Logan, I'm going to jump right in. What do we got? What's this?
Here we go. This is the NAR's total active listings data. It is one of my favorite charts, one of the charts that I've used recently to kind of expose the people that have said that we're going to have a massive inventory spike. This goes all the way back to 1982 to the last existing home sales report. As you can see here, from 1982 to 2023, if you look at an average, about 2 to 2.5 million active listings is the norm. We had more inventory back in the early 1980s. We have a lot more people now than back then. So one of the things I've tried to talk about in my work over the years is that inventory channels in America are much different after 2010. Why do I say 2010? 2010 is after the qualified mortgage laws were put into place. This means housing lending is going back to its boring roots. Fixed debt cost, rising wages, homeowners, once they buy their homes, are shielded from inflation or higher rates or anything of that matter. And they also typically live in their homes longer and longer. So the only time in history, going back decades, that we had an inventory spike was the 2006 to 2011 period. Now, if you look at the chart, if you go back to 2000 itself, total inventory was about 2 million. During the housing bubble years, inventory kept on rising. Monthly supply was down, but total active listings kept on rising. Back then, we had a massive credit and sales boom. People can list their homes, buy a house freely, the next one. Didn't have very much constraints. And then when the credit boom busted, you could see the spike. It's never happened before. That's what we call forced credit selling. There's going to be another chart later on that goes into the details. That market will never exist again. So a lot of people, the housing bubble boys, the people that I've dealt with for many years, have always talked about mass supply coming onto the market, except this is the difference. A traditional seller in America is also a traditional buyer, 75 to 82% of the time. So when demand picks up, mortgage rates go down, demand picks up, first-time home buyers, they're not selling a house, they're buying a home. Inventory levels slowly fall and fall and fall. And for my work, I've been doing this for over 10 years. I've always talked about from 2008 to 2019, that housing would have its weakest recovery ever. Economics is demographics. We were very young as a country back then in terms of our first-time home buyers. But years 2020 to 2024, we would have the best housing demographic patch ever recorded in history. There's also a problem with that. As you can see with the black line chart that I've always drawn on these data lines, inventory has been slowly moving lower and lower and lower. And then here comes 2020, housing demand broke out, pre-cycle highs, all before COVID hit us. Inventory fell to a level that I deem to be savagely unhealthy. What I call is forced bidding, too many people chasing too few homes. So when mortgage rates started to rise, of course, the housing crash, people said, oh, here it comes, massive inventory, massive inventory. You guys see the inventory in the bottom right corner. If you need your glasses, please get them. That's all it was. We had the biggest sales collapse in 1 year and ever in history, and we never even got back to the range that we saw from 1982 to 2023, right? So homeowners are in a very good spot. They have been for a very long time, well before COVID. A lot of them got to refinance again. They have a very low payment, total housing costs. So people have been living in their homes longer and longer. From 1985 to 2007, housing tenure was about 5 to 7 years. From 2008 to 2023, it's about 11 to 13 years. There's parts of the US that are 15 to 18 years. I've lived in my home for 19 years. So people aren't as moving as much and their financials are good. So when the housing sales crash happened, inventory did grow last year. The last time inventory grew in America was actually 2014. Back then, purchase application data went down as well. I'll have another chart to even make it more clear. And total active listings grew. But here, we're not even anywhere close to the 4-decade average because homeowners are doing well. So that's what we wanted, right? We fixed the credit systems so they could do well. But they also do not sell in panic. The people that tell you homeowners sell in panic usually are stock traders, because stock traders are usually on leverage, or professional grifters on YouTube that keep on saying, people are going to rush to the market, they're going to sell their homes. No, we just had the biggest collapse in sales and we never even got close. So hopefully this chart, and if you want to show your clients, this is the reality of the inventory world we live in, going back to 1982. Nobody likes to show this chart every year. It might be the first time some of you have seen it. I just wanted to show scale because when you adjust this chart to population and households, inventory is near all-time lows. And we already had the home sales crash. So when people are like surprised that home prices aren't crashing this year, there it is, right? People are stuck in the marketplace for the second half of 2022 when demand was collapsing. Well, demand is no longer collapsing anymore, and active listings are at all-time lows. So this is the NAR data itself. We're going to go even faster with the weekly data here at Housing Wire. So the next chart that we're going to show here is what we do at Housing Wire. We track weekly data, right, up until the very last week. I do this every single Monday or every Sunday night for Housing Wire. We call it the Housing Wire Tracker. We track inventory, we track purchase application data, we track the bond market, mortgage rates, what's going on in the economy to give people a forward-looking view of housing. This is single-family, unoccupied, active listings. As you can see, we've been trending lower and lower for years. We broke to all-time lows in 2022. Do you know how many single-family homes we had at the bottom? 240,000. That's it. For a country of over 330 million, for a country that has the biggest housing demographic patch ever in its history, ages 28 to 35, we had 240 single family homes. So even though home sales didn't look like what we saw during 2002 to 2005, booming home sales, credit expanding, we just had too many people chasing too few homes. So we had the biggest mortgage rate hit ever recorded in history. And then we had the biggest home price hit in a very short amount of time with sales collapsing. That's all we got. Inventory has stabilized. Demand has stabilized. So what I do is I track weekly active listings, and then I'm going to track weekly new listings data. So the next chart is even more important. That's the new listings data. This data line has been falling for many years. Even when mortgage rates were at 3% in 2021, new listings data was trending at all-time lows. Even last year, when we had the big spike in mortgage rate, new listings data showed a little bit of growth year over year, especially in June, but we're at all-time lows. This year, fresh new records, fresh all-time lows. When mortgage rates got past 6.25, as you could see in the blue line and the green line, 2022 started to decline noticeably on a year-over-year basis, and we never really recovered from that. So one of the things that especially when I talk to Wall Street, I say, imagine yourself as a seller, right? You want to sell your house and buy another one. You just saw mortgage rates jump from 3% to 6% in a very short amount of time. And then you see them slowly come back to 5%. You go, maybe I can pull this off. And then all of a sudden it goes from 5% to 7.5%. That is not a functioning marketplace. Our mortgage market resembles like a third world country when our dollar gets stronger and rates are wild for them. So what it's done, it's spooked some sellers, right? And sellers are not going to put their homes on the market and then all of a sudden think, okay, what if mortgage rates jump on me 2%? So that could kind of explain the noticeable year-over-year decline after the big mortgage rate spike. So we haven't really gained that back, or we're nowhere even close to what we saw in the previous decade. Just from some examples, we would have 90 to 85,000 weekly new listings back in 2015 and 16. We're at 60, 65,000 now. So we're not getting the new listings growth. But when people list their homes, right, people go, well, how can we have these big sales numbers if inventory is so low? Remember, they list their homes, they get an offer right away. They buy, the house does not become active listings. It's going to be gone by the market by the end of the month. So the new listings data has shown once again, homeowners aren't stretched. I mean, if last year was the big collapsing year and massive supply, what you would see is new listings data spike much higher than what we saw in the last 4 or 5 years. None of that was happening. This is why we created the tracker at Housing Wire. For every Sunday night, people can actually look at the forward-looking data. Now, as you can see here, inventory is very seasonal, right? We have about 8 more weeks left before the seasonal decline. So we don't see any stress. We have never seen stress in the inventory channel data for 12 years now, right? So anybody who's talking about mass supply does not understand the functioning of the housing market and how new listings data go. So now you have total active listings, the NAR going back to 1982. You have perspective, right? Now you have the weekly active listings, single family, 450,000 around. I mean, there's not much out there. And now you've seen the new listings data. My belief is if economics is done right, it should be very boring. It's not designed to be this sexy hot dance or anything like this on TikTok or YouTube. It's designed to show you a series of data lines with millions of people working together to show you a trend, connect the dots. You want to be the detective, not the troll. So this data line, if you ever saw stress in the housing market from homeowners, you would see this data line spike noticeably week after week, week after week, year after year, year after year. Never happened. You can see the other data lines, never been the case, even with a big sales collapse, not happening. So that entire talking point that was done last year by YouTube, by some Wall Street analysts, none of them are housing people, right? They're not trained to be housing people because they don't understand the credit channels or inventory channels. Here, you have it all at your fingertips at a fraction of the cost of what Wall Street would charge you. So hopefully this gives you some perspective on the inventory data going back to 1982, the weekly data on active listings and new listings data right now. Now, the next chart will go into some of the dynamics of demand. If you remember the housing boom years, credit was booming, sales were booming, prices were booming, housing starts, completion, everything from 2002 to 2005. And then we had the big collapse. If you can see 7.26 million existing home sales, the peak in 2005. When that demand collapsed, two things happened. Credit availability index, just to give you some numbers, the MBA's Mortgage Banking Association's index, it went from 400 all the way to 900, then from 900 collapsed to 100. Credit collapse, sales collapse, inventory spike. What we had last year was historic. Monthly home sales had a waterfall demand, but no inventory spiking. So if you want to understand or explain to people why are home prices up still year over year, month after month, demand collapsed, but inventory didn't increase. Why? Because homeowners are doing well. One of the things that the biggest thing that people don't remember about 2020, 2020 existing home sales were only 130,000 more than 2017 levels. So we never had like a credit sales boom. So we didn't have this over leveraged housing cycle. So sales can fall, but it doesn't necessarily mean home prices are going to crash. And hopefully by now, everyone's actually seen this data to realize there is a major difference with the housing cycle, and it all revolves about homeowners are doing well. We'll have some more charts later on that, but there's a big difference between this cycle, the previous expansion, and what we saw in the early part of the century. The next chart will be even a little bit more telling as well. One of my favorite things, purchase application data. This is from the Mortgage Banking Association. It is a survey data. It's not a volume data, but just basically a survey. I always draw that black line from 2002 to 2005 to tell people that was such a massive credit boom. And whenever you have a massive credit boom and credit bust, the entire sector goes through a lot of pain. It needs to deleverage, right? Homeowners were filing for foreclosures and bankruptcies years before the recession. None of that was happening in the last 12 years. One of my long-term calls in the previous expansion when I started writing about housing in 2010 is that the MBA index will never hit 300 until years 2020 to 2024, right? Household formation grows, mortgage demands will grow with that. You see that in the bottom in 2014. We kept on slowly increasing, and here comes the biggest demographic crash. Wow, boom, economics is demographics, there you go. Housing has good replacement buyers. I don't ever call it, a booming housing market, but great replacement buyers. So what do I mean by that? First-time home buyers, move-up buyers, move-down buyers, cash buyers, investors. You put them all together, it's a pretty good decade. But now, with inventory breaking as low as it has, guess what happened? Forced bidding, home prices escalated out of control, right? And as soon as mortgage rates rose, and we're not talking about a mild mortgage rate, we're talking about a historic rate, demand collapses. But just like from 2005 to 2007, we saw the inventory increase there. Here, we had another waterfall demand hit. And still, the housing market in terms of inventory channels and credit channels are stable. Why? Because homeowners in America have never looked better. Our family's been in banking since the late 1950s. And I can tell you this, on paper, what we have seen, because why? Fixed debt costs, rising wages, cash flow looks better. Homeowners are in a good spot. And in an inflation environment, which we haven't dealt with many decades, the best inflation hedge on planet Earth was a 30-year fixed mortgage in America. Why? Because your wages go up more during an inflationary period, right? To compensate for the cost of living. but that mortgage payment, that debt cost stays the same. So now you can see that we were already below 2008 levels in this index, and yet we are easily 1 to 1.5 million away on active listings from anything being normal. That's why that one chart in the early is very important. And you can see the stability in the inventory channel, even with a demand collapse. So this chart gives you an idea of what we had back then, what we were having going up to years 2020 to 2024. And yes, we had the biggest collapse in sales, and still the housing market is functioning in a stable environment. It's really mortgage rate and prices that impact demand here. And that's how it should be, right? Prices, mortgage rates, those things impact, even if you have very good demographics. The housing inflation hit was so severe. For myself, for my work in this year's 2020 to 2024, I said, housing will be fine as long as home prices only grow 23% over the next 5 years. If people go, home prices can't grow 23%, it's a bubble already. Okay, watch. We escalated out of control. Within 2.5 years, we're already up 42%. That was my biggest fear of housing. I went on the media networks, late 2020, early 2021. Don't worry about forbearance. I was so sure that forbearance was never going to be the thing. I coined those people, the forbearance crash bros. Professional grifters, YouTube, Facebook, you probably see them, Instagram, Twitter, forbearance. So it's like, nope, forbearance is at 5 million. It's going to slowly go down to under 500,000 eventually in a year. That's what's happened, right? So again, homeowners in a very good spot. They have a very low total housing costs, even with the collapse in mortgage demand, right? Mortgage demand is most buyers. You can see that we still have a very stable inventory channel. And going to the next chart, we also taking it to another level. This right here is probably my money chart. Every conference I go to, every Wall Street firm, everything, I show this chart because I have to explain this, because this really explains everything, not only for the US economy, but for the housing market. As you can see, bankruptcies were much higher back in the early part of the century, and then they kind of stopped in 2005. I think people forget there was a 2005 bankruptcy reform law, right? That was designed to absolutely make sure that people don't over leverage themselves on credit and just file for bankruptcy easily. So that's why the bars for the bankruptcies were exceedingly high and then kind of declined very noticeably. But as you can see in the black line that I draw, again, I'm very, very happy about drawing black lines because I want to show a trend. 2005, 2006, 2007, and 2008. All of these years have one thing in common. People were filing for foreclosures, bankruptcies, all before the job loss recession happened. See, that was a credit boom and bust. That was exotic loan debt structures. Housing's traditional lending risk is what we call late cycle lending. People that buy a home very late in its expansion, very low down payment. If they lost their jobs, right, it takes 9 to 12 months minimum just to get the foreclosure process started and maybe finished. Back then, we were already seeing this stress. None of that was happening at all whatsoever in the last 12 years. Why? Because we fixed the credit channels. And as you could see below, if you could look very carefully, you'll hear people say, oh, foreclosures are up 700%. Perspective, right? Household formation, demographics, credit, everything looks great. Foreclosures will go back to the pre-COVID trend. That'll happen because we're starting the process of old foreclosures from 2018. However, what's going to happen is that the 30-day lates, 60-day lates, 90-day lates in America are all at all-time lows. The new listings data is at all-time lows. When you would see housing stress, you would see 30, 60, 90 days late start to pick up, and then you'll see new listings data explode. That's where people are going, what I call forced equity sellers. So many people have equity in their homes, and then 42% of homes have no mortgage on them. So there's a lot of nested equity. Those people, if they are stressed, would probably sell their house. But there's nothing in the data, and that's why we created the weekly tracker, so we can take the fastest data possible, right, to give you a trend change. And what happened last year, part of my work in October 27th, I wrote an article for Housing Wire, the case for lower mortgage rates. Doing my bond market channel, geeky, nerdy work, I said, okay, this is where the 10-year yield should be falling at this point. Let's take a look at what housing demand does with that. starting from November 9th, purchase application data started to get better, right? And because it got better and there was no credit explosion, inventory levels stabled out. And for 6 months, the housing data got better. Nobody cared about it, right? The media doesn't want to say it. Crash, burn, prices down. You see these economists, they 15 to 20%, 10%, 15%, 20%. They're just sticking something up and hope it sticks, right? Those are not models, right? You have to figure out affordability indexes models. They're just saying nice round numbers and hopefully somebody will put them on TV and stuff. What's happened is we never had home prices fall last year, right? The total prices were increasing. The month-to-month data got bad the last few months of the year when mortgage rates spiked up. But right now, the dynamics of housing has changed. Inventory levels are low, demand stabilized, and as you can see here, credit looks really good, right? And I think that to me is, we just came off the longest economic and job expansion ever recorded in history. If it wasn't for COVID, we'd still be having that because household balance sheets look so much better. And it goes back to the core root of housing. Why do we have 30-year fixed mortgages here in America? Fixed debt cost, rising wages. Some of the next charts will explain what I mean. Mortgage origination by credit score. Now, people will say there's some FICO score inflation, right? These scores are really booming because no, it isn't. The scores have basically been the same since 2010. It's just that we originated more loans, purchases and refinances together. That's why you see a volume increase. If you actually look at it past 2010, everything looks great, right? The cash flows of American households are good. So when people say, people try to lie to you and says, oh no, it's just the FICO scores are wrong. No, it isn't, right? They were good buyers from 2010 and on, and they just got better and better and better, right? You hardly see any low FICO score buying anymore. So the credit channels always showed that Americans were doing good. So traditionally, people don't sell to be homeless. I know it's an interesting concept, but you just don't think, okay, I'm going to sell my house and buy something with much higher cost or rent at a higher cost. No, homeowners are doing well. If there's a job loss recession, of course, you're going to get some stress in the data. But as you can see here, for 12 straight years, there was nothing in the data that warrant the over panicking of the housing market in terms of stability of inventory. And we just had the biggest crash in sales. So people go, why aren't people selling? Why would they? Right? It's an interesting concept, sell to be homeless. Never seen it happen before, but keep on fooling yourself. This is it. Credit matters to inventory data, housing economics, and in the general economy as well. Look, we're dealing with inflation. The Fed wants to create a recession, everything. Labor markets are holding up still because the household balance sheets in America have never looked better. And trust me, all around the world, they are jealous of us because a lot of countries have short-term debts. Their debts payments are going to recast over and over. Here in America, not our issue, right? We have the least exposure to short-term debt in America. Next chart will be even more clear for us. Home prices, right? They really took off. Now, equivalence of rent is how the government tracks rent. Rent inflation is always growing because most people are always working. So rent inflation really doesn't have what we call big deflationary collapses. We had a few months in 2010 where the shelter inflation index for CPI went negative, but not here. Now, the housing bubble years, we had a massive credit boom, right? And then we had a credit bust. So all those charts I showed to you in the past, right? What do we know now? We know credit was deteriorating 2005 to 2008. We know demand was collapsing from 2005 to 2008. This is all before the job loss recession. Here, we had an unbelievable spike in home prices, right? For me, I called it the savagely unhealthy housing market. For me, it was trying to convince people that we have to worry about home prices accelerating out of control, not decelerating. But even with the biggest collapse in home sales, the index is firmed up. Like, how is that possible? How is it possible that the month-to-month data is still positive and the year-over-year data is still positive? It was because rates went lower, mortgage demand picked up, total inventory, right? You have 3 different charts to tell you you're at all-time lows. In a stable housing market with demand, low inventory matters. When demand is collapsing, like we saw last year, the month-to-month prices were declining. Yes, even in a seasonal declining period for pricing power, we still saw the month-to-month prices fall. But that was with rates going from 5 to 7.5% in a seasonal week period. We saw new listings data's decline. That marketplace is gone for 6 months. 6 months, starting November 9th. People who follow my podcast or listen to my work, I said November 9th was the start of the change of the housing market. Let's see who finally picks up to it. And even today, people are still talking, home prices are crashing 20%. No, they're not, because demand stabilized. And as you can see in the top right-hand corner, right, you don't see the decline anymore, right? We had a little bit of decline from the peak, but it firmed up, right? So this hopefully can show you that when we do have major price crashes, we see inventory skyrocket. You go back to that first chart, you can see it, vertical inventory. Then that downtrend since 2007, really. And we haven't been able to get back to it. Now, I do believe the history of inventory channels show that inventory can grow when there's weakness in demand. And then we see days on market growth, homes take longer to sell, but you don't have the inventory spike like we've seen. Every single year for the last 7-8 years, I've had to deal with inventory is going to spike. People are going to rush to get out. That's a Wall Street thing. That's a YouTube thing. That's a grifter thing. That's not how housing economics works. You have the data now, right? And you're going to see the data every single week. We update it to the weekly data. If there was anything like that happening, we would see it in the new listings data and the weekly inventory. We don't have to wait for the NAR reports that are still lagging behind. We have the fresh newest data. Not the case. And this is with mortgage rates not really breaking under 6% yet, right? So now we can see 6 to 7% rates now are not the 6 to 7% rates that we saw last year, right? The market is adapted to it. Demand is stabilized, and we're dealing with the realities of an economy where the Federal Reserve really wants to push for a recession to fight inflation. But if that's the case, then traditionally what happens after 1982, bond yields fall like they have since October 27th. Rates tend to fall with it. The mortgage market is still terribly not functional. If it was normal, rates would be at 5.25. Could you imagine the housing market if mortgage rates were 5.25? I can tell you, we still have people talking about 20% home price crash, right? You have the data now. You are smarter than a lot of people that you see on TV now because you can see the difference, right? Like I always say, be the detective, not the troll. Next
All right,
slide.
Logan, I'm gonna give you a voice break to grab water for a second.
Oh,
for those of you that haven't already, post your questions in the Q&A. The last 10 or 15 minutes, we're gonna catch all your Q&A. So keep those coming. This is amazing. Next slide, you're back up. All right, did it go? Did it advance to the next slide or no? I think it did for me.
Yes,
There you go.
There we go. This is US nominal home prices and real prices. Okay, real prices adjusting to inflation, the equivalence of rent. As you can see, real home prices are falling a little bit, but nominal home prices aren't. So what I want everyone to do is focus on that upper corner right level. This is a more clear version of what's happened in the housing market. The last few months of 2022, the month-to-month prices were declining, right? The market could not handle rates going past 7%, right? And the people that were selling their homes, right? Selling your home is very seasonal. They were cutting prices to get the product off. But as rates fell, demand stabilized, you can see that nominal home prices are upticking again, not crashing, upticking again. Now, you're going to see a lot of people that are going to say, but real home prices are crashing or falling. This is true. There's a difference between nominal home prices and real home prices. So real prices adjusting to inflation, those data lines are going to be much more negative, but on a nominal basis, 4% year over year growth, 0.5. Remember, we already had the sales crash. So people that are talking about we need home prices are going to fall another 20%, they're going to need to see sales collapse even more. And it's not the case. This chart gives you a little bit more of a clear view of the nominal versus real, but you can see this. As soon as rates started to fall, even at above 6%, the pricing firmed up. So if you're out there and your buyers are going, where's the inventory? You have the data now, right? You have all the data at your fingertips to say, this is the inventory levels. Now, for us at HousingWire, Altos Research, they actually have live inventory data for every zip code in America. Every zip code, you would have the entire buyer versus seller inventory channel, and gives you a grade of it. Is it a seller's market or buyer's market? Because we believe weekly inventory, weekly housing economic data matters more than old lagging data, because a lot of people are still stuck back in the 2022 housing market, and the pricing, you can see it right there. It's changed because the data told you it was changing for months. Next chart. This is basically my core work. Bond market 10-year yield channel calls. What is that? The 10-year yield and mortgage rates, what I call, has been doing a slow dance. They are in a lovely romantic relationship since 1971. Whenever the 10-year yield goes up, mortgage rates go up with it. Whenever the 10-year goes down, mortgage rates go with it. They've been slow dancing. The mortgage-backed security market is very stressed, so there's a little bit of space between their dance right now. But for me, I think what a lot of people know me for is forecasting bond yields to where mortgage rates is. So what do I mean by 3.21% to 4.25%? So far this year, the 10-year yield has stayed within that range. That means rates between 5.75 and 7.25%, right? I talked about the peak of the 10-year yield last year, the peak of mortgage rates. The next stage is mortgage rates and the 10-year yield should fall. Now, the mortgage market is very dysfunctional this year. We should be at 5.25% today in a normal mortgage market. Adjusting to knowing that was going to be the case, that's why I have rates higher than normal. But when the economy gets weaker in terms of the labor market, and I track all the labor market data as it's part of my work, the Conference Board, which is a big economic firm in DC, they give their work to the White House, to the Wall Street firms, even the Federal Reserve. They asked me to present my recession red flag model to them. And one of the things I've talked about is that next year, if the economy starts to soften up in terms of labor data, which we've been seeing lately, the 10-year yield can break below 3.21%. There's your below 6% mortgage rates, all in the 5 handle, but it needs jobless. Jobless claims comes out every Thursday. It's still under 323,000. I believe when jobless claims break over 323,000 on a 4-week moving average, the Federal Reserve will start changing its tune, because that means we have a job loss recession. Now, people are going to say, oh, here comes a recession. Housing's going to crash, inventory. During COVID, April 7th, 2020, for the post-COVID work, this is what I'm probably known for the best. I wrote a recovery model for HousingWire. HousingWire wasn't even going to publish it. It was crazy. I was saying that everything's going to recover in 2020, especially housing. And even though it published, and some of my economist friends were saying, why do you think housing is going to come back? And this is the key of all housing economics. They kept on telling me 20 to 30 million people are unemployed. I said, you're absolutely right. You forgot the 133 million working. My army's bigger than yours, right? So I'll take my 133 million people working with low mortgage rates and good demographics and credit still flowing versus your 20 to 30 million people that are more tied to renter financial profiles. Housing recovered within 6 weeks. It's a COVID-19 recovery model. I even have it on my blog if anybody wanted to read it. It worked. Now, the next recession, we have 155 million plus people working. If mortgage rates fall, housing is disproportionately impacted in a favorable light. Last year, we had a booming labor market, 4 million jobs created. Housing went into recession in June 16th, 2022. Why? Mortgage rates shot up. Housing is disproportionately affected negatively when rates go up. That's why they always say housing's a cycle, right? When housing's in recession earlier, it's the early stages of going into recession. But when it's recovering, right? Why? Because mortgage rates typically fall when the economy gets worse. There's your housing demand. So we already took the major shock. So when the labor market breaks, right? 10-year yield goes down, mortgage rates go down. Don't run into the 2008 scenario. All those charts that I showed you right now, I've already showed you, there's nothing in 2008. Credit is very available to people. Why? Because Freddie and Fannie are in conservatorship. If they were publicly traded companies, what are we doing right now? We see what's going on in the bank stocks. Oh, they have great capital. It doesn't matter. Publicly traded bank stocks, boom. We have a banking crisis. But they're not. So that's a huge important factor. Freddie and Fannie not being publicly traded companies that are not under conservatorship would be a negative for the U.S. housing market. Majority of all loans are bought or insured by government agencies. There is a huge, huge plus for the housing market. It was during COVID. It is right now. So rates over job losses. We have 155 million people. Somebody told me, well, Microsoft laid off 10,000 people. That's going to kill the housing market. I'm going to take my 155 million versus your 10,000 any day of the week. You're not the Spartans. You're not going to win. Think of that when the next recession happens. Lower rates, more buying power, more people working out. When we look at recessionary data, what we see is that the people that never graduated high school have the highest unemployment rates. Service sector workers tied to renter financial profiles. That's the reality of the data that we work with. That's going to be the majority of the higher unemployment rate. College-educated Americans, 2% unemployment rates. Even at the peak of the great financial crisis, it was 5%. So renter financial profiles will get hit. Home buyers benefit because majority of home buyers, home sellers that will buy will benefit from lower rates. And right here, so far, the 10-year yield mortgage rates have looked perfectly normal to me, even with the banking crisis. But once the labor market breaks, the Federal Reserve will change its tune. The 10-year yield should fall. The mortgage-backed security spreads will initially get hit hard, but the Federal Reserve, if they wanted to, can fix everything just by snap of their fingers. They don't want to do that right now. But when that happens, that is, again, disproportional benefit for housing, not a negative. You're going to hear a lot of negative takes, but I've showed you what the credit channels look like. It's not there. And we already had the sales crash, right? It's really rare in America after 1996 for home sales to trend over below 4 million monthly. And it's because we have 330 million people. Our civilian labor force is 167 million. We have over 155 million people working. That's why. And when I talk about a slow dance, you see the red and blue chart. This is my main thing about mortgage rates and the 10-year yield. If there's one thing that I want to get across to everybody, is that these two literally have been dancing together since 1971. Now we see the spreads get a little bit wide, so there's a little bit of separation, but where the 10-year yield goes and what drives the 10-year yield drives mortgage rates. We're going to have a lot of skeptical theories that the Federal Reserve manipulates mortgage rates, or it's only done by one group of people that hate everything. I call them the anti-central bank people. It is a permanent 24/7 doomsday group. Most of them are baby boomers. They're riding it out. There's no manipulation here. The 10-year yield, we had inflation in the mid to late 70s. Mortgage rates, everything run with that. The growth rate of inflation has come down, but the bond market, like I've always talked about with my work, has never believed in the 1970s inflation story. And they shouldn't, right? The history of global pandemics going back 800 years. You see this major inflationary push early on and then the disinflationary factor after. With that reality, I said the 10-year yield peaked in 4.25. Mortgage rates should go down because the 10-year yield should go down. And just imagine if we had normal spreads, we'd be talking about 5.25 mortgage rates today. Even the biggest housing crash person in America would have to change their tune. Why? Because the 10-year yield falls. So that 10-year yield forecast I did in my 2020, that's my work, right? I'm trying to forecast bond market channels with the economic data, with mortgage rates to give people an idea. And again, the market changed. October 27th, the case for lower mortgage rates was a case for the bond yields to go down. They did. Housing change. If it keeps on going lower, that is a net benefit because disproportionately housing gets impacted on a positive light.
All right. That was tremendous. And there's a bunch of questions. So I'll give you a minute to catch your breath. And I want to play back to you what I took away from what you just said, which is the key points. 42% of homes today don't have a mortgage. People that own their home today are generally in pretty good shape. Homeowners are in a great space. We've already seen the big pullback in the number of sales, and inventory didn't spike. And the case for the housing market from a price perspective to accelerate again is really when that combination of interest rates come back down and the slow dance between the 30-year and the 10-year kind of tightens back up to a historical place. You see rates move down. What you said is rates should be 5.25 today. what I read between the lines there is if your prediction about bond yields going to 2.75 is right, and that spread kind of comes back to normal, that you can see rates in the fours, and then you're really off to the races in terms of home sales. I think that's really exciting. I want to get to some of the Q&A, but Logan, you and I talked a little bit in the pre-call about this, and I think your debunking or kind of putting a flashlight of truth on this will be really important. And so I'm going to screen share a slide. Now I've blurred out the channel that this was snipped from, but I saw this on social media. I'm sure we've all seen this slide. If you're in real estate and people know you're in real estate, they've asked you about this slide. Logan, like, what's the deal here, man? What's going on?
It is such not a big deal that I even refuse to even talk about it. I mean, when I saw this, the first thing I thought about it was that the pricing changes made last year to cash out loans and second homes or investment was more of a bigger deal just to that sector. This is just kind of moving the fee, really the discount fees on pricing on certain loans that, as my chart showed all the way back with the credit FICO scores, low FICO score Americans don't buy homes. They will not buy homes after 2010. We've changed the credit system. So in a sense, this is an ineffective way to try to think this is going to move the needle. And it's just not, it's not that big doing on the matrix. So that was my first and open take. And of course, everything gets blown out of proportion. But to me, it's one of the least important stories of 2023 because it won't move the needle either way. If you have a good FICO score, you're still going to get the best rate. If you have a lower FICO score, which we don't even see lower FICO scores, people really applying for loans in any big fashion. This has been a big part of my work actually for 10 years. They're not going to move the needle on that side either. And you're still going to get on majority of the loans, still A paper pricing. So it's a non-event really in the big scale terms. I think if you wanted to make it a bigger event, you would really flip the pricing to the lower credit side, and they didn't. They just basically moved some of the fees from one end to another on certain programs that it just doesn't have much velocity. But it's great for headlines, though. If you want to do headlines, this is unbelievable, right? But it really shows that you can't get your information from Twitter, TikTok, or the news unless you're like really versed. And again, I'm talking about somebody who's said for many years, there's no tight lending in America. We've always had very liberal lending standards. You could get FHA loans with 620 FICO scores. It's just that these people don't apply for home mortgages, right? Because the reason you have a low FICO score is that you can't make your credit card payments on time. You have huge balances, usually means you don't have a lot of cash flow or reserves. They don't buy homes. It's never going to turn. And it's been actually one of my debating talking points for 10 years with Wall Street or institutions that want to get lending more liberal. But I say it's not going to do anything. It just doesn't work. After 2010, when the Q qualified mortgage laws are in place, we're all good, and we're still going to be good. Not a big event.
Yeah, and for the agents listening, the key to understand about that headline is it does not mean that a borrower or potential borrower with a lower FICO is going to get a better deal than somebody with a higher FICO. What it's doing is it's comparing the rate of change of the old loan level pricing adjustments to the new ones. And so we can put out some more data on this so that you all can understand it. But I think Logan nailed it. It's a big headline. It gets people to click on stuff. It's sensational. It's probably actually a little misleading.
Anything that can make people think that lower FICO score people are buying homes are going to push it to 2008. 2008 is a marketing gimmick. That's why the housing crash people use it for their great YouTubes. It's not the case. And again, that's why I put all those credit channel charts up there so people can understand lower FICO score Americans don't even apply for loans. They're never going to be a part of the big factor. It's actually an ineffective way, to be honest with you. If I had to talk to the FHFA and say, you did this for no reason, it's not going to be a really big movement on this. But the terms of this really pushing the market on one side, it's laughable out there. But for me, it was actually funny to see this, how it became a big deal, because I always say that they're trying to manipulate you, right? They're trying to make you think about 2008. That's their job, because they need you to watch, they need you to click. that's what they do. This is the yellow journalism, sensationalism, the post 2008 social media world we live in. And people like me, we're boring. We know it, but we try to bring the facts into it, the data into it, which I know is not exciting. I always say that if you do economics right, it's not that exciting.
Yeah. So speaking of data, there were a few questions about like, hey, you got all this great data. Where do you get it from? I know you get some from NAR, but Housing Wire, actually, you'll have a product where agents can get this data in real time. Can you talk a little bit about that?
The Housing Wire tracker incorporates the bond market is basically the bond market data that anybody who tracks the 10-year yield or has a device that tracks the 10-year, anybody can do that. But I incorporate the bond market, the mortgage-backed mortgage purchase application data that you saw, the red line charts. And then Altos Research is weekly data. Nobody has that. It goes up to the very last day on Friday for the previous week. So what I do is I incorporate the weekly data, the bond market data, the purchase application data, then all the economic reports that are coming out for the next week. And we try to format where we think housing is going, because purchase application data from the Mortgage Banking Association, it looks out 30 to 90 days. You don't just apply for a loan and then buy a house 2 days later. It doesn't work that way. But historically, since the mid 1990s, if you track forward-looking housing data, it tells you what's happened. So everyone's shocked. Like people are like, what's going on with home prices? Why isn't it crashing? Like, dude, market changed November 9th. We have a top 10 national podcast, and you can see my humor when I talk about this, that people don't read, right? I always say reading is a good thing. And if anybody read the weekly data, like I've done, I've tracked this, it worked. It's always worked. And this is the fourth time, I would say, in the last 10 years that forward-looking housing data changed. We saw this in 2014, 2015, 2018, and 19. In 2020, it happened so fast that it happened at the same year. And this is the fourth time where the data changed, the forward-looking data changed, and then all of a sudden, now it hits the data lines, 3 or 4 months later, bam, there it is. Now, Altos Research, which is part of Housing Wire, they have a whole different sphere of inventory, pending home sales, but they're very key on weekly data tied to your zip code. Mike Simonson on Twitter will do a YouTube talking about the national data, but he could even specialize it to any zip code out there, which is very beneficial to the real estate agents that have it. My job is to look at the economic data forward looking to try to connect the dots for housing. And it worked again, just like it worked in 2020, 2018, 19, back then. Purchase application data from the MBA, the 10-year yield is the bond market. Altos Research gives us the weekly new listings data, and then I just incorporate it with all the economic data that we have, what's coming up, what reports are coming in as the Fed meeting, everything. Try to make it simple as possible to give people a forward-looking view.
That's amazing. All right, I'm gonna hit you with a 2-pack. One is on this slide, there's a question. So does this mean that the cost of ownership is 53% higher than the cost of renting? Is that how someone should read this slide?
That's just the percentage difference between the FHFA price index versus the equivalence of rent, right? So rents never deflate, really. If you look at the history of rent inflation going back to World War II, we don't have these really big declines in rent because most people are always working. But the price index went up so much so fast. We had 42% price increases from 2020 on. So rent inflation picked up much noticeably too in 2020. That was another thing too. It was hard to convince people that rent inflation was about to take off. But that gap is noticeable. What people thought would occur was that when home sales were crashing last year, pricing would get down, and people try to connect the dots here by these are going to merge together. This is not necessarily the case until you get inventory to skyrocket and sales to stay low for a very long time. So you can see the difference. Back then, during the housing bubble years, when housing was crashing, demand was crashing, inventory was skyrocketing. Rents now have picked up a lot recently in the last few years. The growth rate of rent is cooling down. That's actually going to be good for mortgage rates going out the next 2 to 3 years. We have near 1 million apartments. But pricing now, people buy a home and they stay there for a long time. So it's irrelevant that this index is that high until you see supply increase, demand crash, rates stay higher for a longer time, because this gap can get a lot higher than what we've seen right now. Rent inflation will cool down, but that uptrend that we've seen in rent inflation will stick. It's really rare to get rental deflation decline, but that gap is holding now, right? It's not crashing like we saw previously. And now that you have all the inventory data and the demand data, you could see why. It's really hard for prices to crash when it's hard. It's crazy for me to say this, but this is I have to convince people this. When total inventory is near all-time lows and demand is stable. If demand was crashing still and supply increases, then the people have to sell their homes at a lower price to move product. People are staying in their homes longer and longer. So this chart has been used. I remember going up to 2020, people would say, look, there's such a big gap between the home price index and the equivalence rents. It has to go back down to 2012 levels. No, it doesn't. That's not how it works. It looks like the housing bubble was from 2012 to 2019. Never was the case. Here we had a massive increase in prices in a very short amount of time, but rent inflation took off so much as well.
That's great. So there's a bunch of questions about consumer debt. We hear the headline like, oh, consumers have all this credit card debt. They're, first payment defaults on auto, on credit cards, all those things. What's your thoughts on that?
Consumers' debt, household debt payments are at all-time lows. You always have delinquencies on car payments and auto loans. They're all still at all-time lows. They don't show you the percentages. They'll take you the nominal. Credit card growth rising went with the longest economic and job expansion ever recorded in history. When credit card growth deteriorates, that's when you get a recession. So many bearish American citizens, and this is my thing, from 2010 to 2019 kept on saying credit card growth is rising. Delinquencies were higher in the previous expansion. And we had the longest economic and job expansion in history. So they use the credit deterioration, except we don't see it in the housing data. Why? Because homeowners, consumer liability debt costs to their wages are near all-time lows. Why? Because the majority of people that have debt in this country are homeowners. The majority of the highest income, highest education levels, highest net worth are homeowners. So they're saying, but the renters who got a subprime car loan is defaulting. They have a higher percentage default in the previous expansion. They don't show you that, right? So scare tactic as always. When a job loss recession happens, we do have credit models to track housing. During this entire time, 30-day delinquencies, 60-day delinquencies, 90-day delinquencies in housing, and new listings data are at all-time lows. But nominal credit card debt is growing. Wonderful. We have $167 trillion in financial assets. We have about $18 trillion of consumer debt. We're good. Go ahead. I was saying there's going to be stress in the data, but housing data is different than auto loan data, right? There's a huge difference. We had more stress in the previous expansion, actually in percentage terms. We can see the credit stress come first, but you're going to need to see 30, 60, 90-day lates rise, not at all-time lows. Job loss recession could lead to something like that. Not what we see here. Credit card growth deteriorating, bad for the economy, right? Credit card growth growing still means that people are spending. That's how we've had these long, very economic expansions. So there comes a point to where there's certain households that'll get hit. Renter financial profiles without a high school education has been the deterioration of credit debt. We've seen it for 10 years. We'll focus on that profile when it happens, but that's for the renter side. On the household homeowner side, different case. Mortgage payment as a percentage of disposable incomes are near all-time lows. And that payment is not growing in terms of the debt costs. Why? Fixed debt costs, rising wages.
All right, so we got 1 minute left. Give us the download. Like when is that spread going to close on rates? When are rates coming down? And what's the housing market going to do between now and the end of the year?
So the housing market, I would say it's not having like a V-shaped recovery. It's just stabilizing. But if the jobs data gets weaker and weaker, then the 10-year yield should flow. Now, the question is, when does the spread? The Federal Reserve, if they wanted to, says one sentence to the public, the spreads would get better on themselves. Okay. They are purposely making sure that the housing market is in check because they're afraid of housing going off again. So follow the jobs data, follow the 10-year yield data. I've given you a model of data to track housing data. It's in Housing Wire. It's a tracker. Wall Street follows it. The Fed follows it. It's here to give you the freshest look. So if bond yields fall, mortgage rates fall, that is a net benefit for housing. We saw that happen from November now, except right now we're just stabilizing the data. To get to that next stage, we need mortgage rates to fall. And usually that's going to take the labor market to get weaker. And then eventually the Fed cries uncle and says, okay, we've already got our job loss recession. We want to make sure that it doesn't get worse. In that environment, with sales as low as they are right now, that's a benefit for housing, right? If rates were higher and the economy was booming, right, we're still dealing with that. But here, different story. Don't get caught into the 2002 to 2008 credit models, right? Wall Street has been wrong for this for a long time. Crash people have been wrong. There's pure raw data to show you when things are breaking apart. We don't see it yet. We have not seen it yet. We saw an affordability crisis. Prices and rates went up so much so fast it crashed sales, but you can see it now. You have all the data that the market just stabilized, and it makes sense what's happening with pricing.
That's tremendous. Great way to end it. Thank you so much. Everybody in the chat, please say a huge thank you to Logan. We're going to send this out to you. We're going to send you all the links so that you can follow Logan on social. You can follow Housing Wire. You can get subscribed to Housing Wire Plus. In fact, Logan has offered to share a discount code for you. So thank you so much to all of our Ojo Select Network partners. We couldn't do this without you. Thank you for delivering the value to the consumers that we introduce you to across the country. And Logan, a final thank you to you. I've got pages of notes. This is tremendous. Hopefully we can have you back later in the year. Thank you again. Y'all have a great rest of your week.